Ever feel like investing is this secret club, with a language only people on Wall Street understand? Well, today, we're going to crack the code. We're going to show you exactly how to get started, step by step, even if you know absolutely nothing. Let's do this. So you work hard for your money, right? You put it in a savings account. It feels safe, it feels responsible. But what if I told you that by playing it safe, you're actually taking a massive risk you might not even be aware of? Yeah, you heard that right. That money you've so carefully saved up, it's actually shrinking. Every single day, it buys a little bit less. And it's all thanks to this silent, invisible force that's constantly working against you. So how do we fight back? How do we actually make our money grow instead of shrink? Well, here's our game plan for today. First, we'll dig into the problem with cash. Then we'll uncover the magic of growth. After that, we'll get you your investing toolkit, build a sample portfolio, and finally, lay out a super clear path for you to get started. Okay, let's start with the big problem. Why is just holding onto your cash a bad idea? It really all boils down to one simple but incredibly powerful concept. And that concept is inflation. Forget the textbook definition for a second. All it really means is that over time, your dollar just doesn't stretch as far. The price of everything, gas, groceries, you name it, goes up. And the value of the cash you've got stashed away, well, it just can't keep up. This right here says it all. Money that's just sitting there is getting weaker. It's shrinking. But money that's invested, that money has a job. You're putting it to work so it can go out and earn more money for you. So if saving isn't enough, how does investing actually create all this growth? I mean, it's not really magic, but honestly, the results can feel like it. It's all about making your money work for you instead of the other way around. And the star of the show is compound growth. This is the absolute engine of building wealth. It's when your investment earnings start making their own earnings. So that $10 you made, next year, it's not just your original money working for you. That $10 is working for you too. It's an amazing chain reaction. And this analogy is just perfect. Think about it. Your first investment is a tiny little snowball. But as it starts rolling, it picks up more snow, your earnings. And that makes the snowball bigger so it can pick up even more snow, even faster. Time is your absolute best friend here. Of course, there's always a catch, right? There's no such thing as a free lunch. The potential for that faster growth, what we call return, it always comes with a trade-off, risk. So investments that could make you more money faster also have the potential to go down in value. The trick is finding the balance that you're comfortable with. So how do we manage that risk? The number one strategy, the golden rule, is diversification. You've heard it a million times. Don't put all your eggs in one basket, and it's a cliche for a reason. It's probably the most important piece of investing advice there is. You spread your money out, so if one investment has a bad day, the others can help pick up the slack. Okay, so we've covered the why. Now let's get into the how. What are the actual tools you'll be using to put all of this into practice? For beginners, let's just focus on 3 key tools. First, you've got index funds. The easiest way to think about these is you're buying a tiny slice of the entire market. Instant diversification, super low cost. Next are ETFs. They're a lot like index funds, but you can buy and sell them all day long, just like a stock. And finally, bonds. Think of bonds as the steady, reliable part of your team. You're basically loaning money to a government or a company. They're lower risk and they're great for adding stability. All right, now let's take those tools and actually build something. And look, your first portfolio does not need to be complicated. In fact, keeping it simple is usually the best way to go. So here's just an example of what a simple, balanced portfolio could look like. You've got the biggest chunk, maybe 70%, in those index funds or ETFs. That's your growth engine. Then about 20% in bonds to help smooth out the ride. And finally, keeping about 10% in cash is just smart for emergencies. Now, remember, this is just a template. You can totally adjust these numbers based on your goals and how much risk you're comfortable with. Now, knowing what to do is only half the battle. Knowing what not to do is just as important. So please, avoid these common traps. Don't try to time the market. Nobody can do it consistently. Don't panic and sell everything when things get a little rocky. Please, ignore the crazy hype you see on social media. And, of course, don't invest money you're going to need in the next year or two. And never, ever forget to diversify. Okay, we've gone through the theory, we've looked at the tools, we've even built a plan. The only thing left to do is to actually take that first step. So let's make it as easy as possible. Here it is, your 4-step checklist to get started. First, open a brokerage account. It sounds fancy, but it's just an account that lets you buy this stuff. Second, automate it. Set it up so a little bit of money gets invested every single month without you even thinking about it. Third, start simple. Just pick one broad, low-cost index fund. That's it. And finally, be patient. Check on it once a month, not every day. Let your plan do the work. And that really brings us to the bottom line. After everything we've talked about, the single biggest risk you can possibly take isn't picking the wrong investment. It's doing nothing. It's staying on the sidelines and just letting inflation slowly eat away at your future. So the only question left is, when are you going to make your money start working for you?